Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenivek on Bloomberg Radio.
All right, we want to stay on this story. Joining us right now is Mona Yacoubian. She is Director and Senior Advisor, Middle East Program at the Center for Strategic and International Studies. She joins us from Washington, D.C. Mona, should President Trump be taking a victory lap here?
I think the president does deserve to take a victory lap, considering what has been accomplished today. The release of the last 20 remaining hostages who were alive, are alive in Gaza. The cessation of hostilities for now, the flowing in of much needed assistance into Gaza. These are important milestones. However, I think the president is perhaps premature in saying the war is over. The difficult steps ahead are the ones that we will have to watch closely to see if, in fact, his aspirations become reality.
And Mona, how does that play out if you were going to say that this is presumably some form of a stopgap and not necessarily a conclusion and marking a next chapter? What plays out? How does this play out? And kind of what's your view on that?
Well, what will distinguish what happened today from ceasefires in the past is if the various points that are laid down in President Trump's 20-point plan are in fact implemented. Critical among them is the disarming of Hamas. Hard to know how exactly that's going to happen. The agreement itself is very short on details. There's also the envisioning of an international stabilization force that would surge into Gaza and be responsible for security. Not at all clear how that's going to happen. And of course, questions around governance and the constituting of a committee of Palestinian technocrats to be overseen by former British Prime Minister Tony Blair. I mean, there are so many details that have yet to be ironed out, let alone implemented. And I think these are the key potential sticking points in the coming days and weeks and likely months.
Mona, and I think it's fair to say, right, a conflict like this that has gone on not just in the last 2 years of a war, but it's been going on for a long time between Israel and Gaza and Hamas. What is Hamas, though, in a world where there is no conflict between Hamas and Israel? I mean, they have been designated terrorist groups. So I'm just curious, what is Hamas potentially going forward in if there's real peace in this region?
Well, I think you point to a really important issue here. I mean, Hamas's raison d'etre is resistance against Israel and against Israeli occupation. Now, presumably, if all of the various elements that would bring actual peace between Israelis and Palestinians come into fruition, then that would indeed sort of, I think, dramatically undermine the rationale for Hamas to continue to exist. But I do think it's really important, Carol, to note this agreement talks about and calls for the disarming of Hamas. It does not call for the destruction of Hamas, as Prime Minister Netanyahu has called for and made a centerpiece of his policies on Gaza.
So, okay, so that's an important distinction. Correct?
Very much so. I mean, we're already seeing reporting that as Israeli troops withdraw from limited areas of Gaza, there is reporting that Hamas is filling in and is taking over. And so, again, this just gives you a sense of how daunting this challenge is going to be going forward.
And Mona, you have more than 30 years of experience in the Middle East and North Africa. With that in mind, what do the next weeks and months, years look like?
Well, I think immediately what's going to need to happen is more meat on the bones of exactly how it is that this agreement that all of these various leaders just signed off on in Sharm El-Sheikh, How will those points actually be implemented? So I think the first order of the day is going to be figuring out how to establish security on the ground as Israeli troops withdraw. And not at all clear how that's going to happen. What are the mechanisms by which Hamas is going to be disarmed, and to whom? Whom will they give their arms to? And then, of course, the other key element of any post-conflict stabilization is governance. You've got to have governance. You've got to have authorities on the ground. Who will they be? How will that structure be set up? Those are really critical questions, and we're a long ways from understanding what the details are that will govern those various arrangements.
Does a disarmed Hamas, just to kind of tie this up, do they want a Gaza, a Palestinian state that actually thrives?
Presumably, they have called and would be in agreement with that. But as always, the devil is in the details. For example, they are saying that Israel must withdraw 100% from Gaza. That is not envisioned by the plan. And ultimately, what does a Palestinian state look like? Is there a way to actually build a Palestinian state from the current set of circumstances that we see on the ground? That is also going to be extraordinarily difficult. As long as these questions remain, there will be space for resistance. There will be space for groups like Hamas or its successor to cause trouble.
Yeah, it's fascinating, right? And you talk about, the building of a Palestinian state, and then there's just the actual build of a land that has just been devastated. So much more to come, and I know we'll lean on you in the future because I'm sure there'll be more to come. Mona Yacoubian, she's Director and Senior Advisor, Middle East Program at the Center for Strategic and International Studies.
Stay with us. More from Bloomberg Businessweek Daily coming up after this. You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, big AI is a big market story as well today. Once again, driving the trade, pushing semi as a group, semiconductors that is, higher today, led by Broadcom, whose stock jumped after OpenAI agreed to buy the company's custom chips and networking equipment in a multi-year deal, part of an ambitious plan by the startup to add AI infrastructure. So we wanted to just dig a little bit deeper into it. Amy talked about it. We certainly are seeing it playing out in the market. Got a great voice, though, Bailey, to walk us through it.
One of my favorite people, I will say.
Bailey must have said Mandeep's name about 5 times on the call this morning.
Immediately. Was like, we need to get him in studio. So perfect timing. And that's why we're joined now by Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh, here in the studio. Mandeep, walk us through this deal, because it feels like every other day OpenAI has a new agreement with some chip manufacturer and the terms are slightly different, whether it's an ownership stake or front buying chips. What's up with this broad compact?
I mean, they are really going after, data center capacity right now. And the way they are doing it is by diversifying their supplier base. So it's not just relying on NVIDIA, which everyone does right now for compute, but really leveraging Broadcom, which is a custom silicon maker. So think about, NVIDIA giving you a generic chip where you can run your AI workloads, whether it's training or inferencing. Custom silicon is used just for the specific workload that OpenAI has to run for its proprietary models. So no one else has any benefit of using a custom silicon because OpenAI is not looking to sell its own chips to compete with NVIDIA. It's looking to use its chips for its own ChatGPT app or any other custom app that it has developed in-house. And Google is a prime example of what a custom silicon looks like because they have their own TPUs, which when you compare it to NVIDIA GPUs is more customized in nature, but it does a terrific job of running YouTube or any other AI workloads that Google wants to run on its chip. So that's what OpenAI is doing. And it has a tremendous cost advantage because it costs a lot lower than the NVIDIA price tag of $30,000 on an average for a GPU.
TPU, tensor processing unit. I just want to make sure I understand. Yeah. What's interesting, though, is I do feel like there's this trend to get chips that maybe don't cost as much, maybe don't use as much power, but do exactly what we need. Is that fair?
Yeah, I mean, look, one gigawatt requires up to 500 to 600,000 accelerator chips. So we're talking 0.5 to 0.6 million chips for 1 gigawatt data center.
Yeah.
Imagine if you can save up to $5,000, how it multiplies, in terms of cost savings. The real constraint right now is power. It's not as if you get a cheaper chip and you are all good. You still need the performance per watt, which is why NVIDIA is so good, because it gives you 5 to 10x more performance per watt than the nearest competitor.
You do it, right?
Exactly.
I want to show, there's a graphic, and one of our producers made it, Elizabeth Cedrin, and I think, we've all been looking at this. It's about OpenAI and all of the companies that they're doing deals with, and it's not even been a month, but they have done deals with NVIDIA, Oracle, CoreWeave, AMD, now Broadcom. And again, it's just late September to mid-October. So is that what this is just giving them a smarter supply chain and having access to what they need? Is it as simple as that?
Well, it's not as simple because they're going across the stacks. Think of, how AI applications are deployed. You need the chip, you need the infrastructure, you need the cloud, because that's where you're doing your inferencing. So they've cut deals with different parts of the stack here, not just the chip makers, not just the power guys, also the cloud guys. So from that perspective,
like CoreWeave, right?
CoreWeave, exactly. And look, to my mind, they are going aggressive in terms of adding more capacity than they probably need, because they think if they get market share, they get the companies or users to use their product, then they will be able to monetize and probably drive some companies out of competing with them because of the scale involved here.
Well, are XAI and Anthropic striking similar deals, or is this the OpenAI show?
I think right now XAI must be thinking, and they are doing a $20 billion deal with some private financing. But look, when OpenAI announces a 10 gigawatt deal, we're talking 500 billion, not 20 billion anymore. So the numbers are getting bigger and bigger.
Well, is OpenAI in this moment in time on October 13th the most important company in the world?
Well, when I look at Mag 7, your Broadcom is not in Mag 7. It's a $1.6 trillion company. OpenAI probably, it's one
and
of
they're up 10% because of this. I mean, also the whole space sold off on Friday, so I don't want to downplay that too much. But
they're not even public. They're not even profitable, as much as we know, right?
Yeah. No. I mean, look.
OpenAI.
So right now, their gross margins would be negative if you factor in the training costs. Inferencing wise, yes, they are making some money. But clearly, if you include everything, and just to compare it with Google has an annual cost of revenue of around 100 billion. That powers all of their apps, Google, YouTube, everything that they run. OpenAI's compute costs are probably north of 20 billion right now. And if they're adding 26 gigawatt more capacity, we're talking, compute costs to multiply at least 25-fold. So from that perspective, you have to ask yourself, how much incremental revenue do you want to see from OpenAI to justify this, potentially $1 trillion in compute infrastructure spend? And that's where Google's infrastructure is so efficient, because just, less than 5 gigawatt of compute gets you to over 400 billion in revenue.
That's pretty cool, to say the least, in a non-financial analysis terminology. Mandeep, thank you. Always a gem. Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh. AI spend and the build out is one read on the U.S. economy and certainly the tech economy. Now to another great read, Bailey, on U.S. economic activity. And we're talking about the industrial supplier Fastenal, which reported earnings earlier this morning, and shares, I think they were the worst performing in the S&P 500 at one point.
Yeah, right now down about 6%. And keep in mind, this is a $50 billion company, so this is no small fish in the industrial space. One of the first reads we get every quarterly earnings season. Missing Wall Street views, broadly speaking. So interesting, what's driving that?
Well, let's ask the CEO, Daniel Florness, is with us. He is Chief Executive Officer of Fastenal. He joins us from Winona, Minnesota. Dan, it is great to have you back with us. Talk to us about the quarter, because it does seem like analysts were noting that the pricing during the quarter was weaker than expected and marks the second straight quarter of softer pricing. And maybe that's why we're seeing the stock down. What do you want to say to investors?
Well, part of the reason our stock's down is it's priced to perfection. If you look at what it's done, year to date and where the multiple has gone. But, we had a really good quarter. We had a double-digit quarter. We hadn't seen that for a couple years. Double-digit growth, sorry. And pleased with the outcome. One of the challenges we had this year was there's a lot of fluidity around tariffs and what it means for pricing. And we will raise price to address costs in our customer supply chain. We really don't want to raise more than that because we believe it impairs our ability to grow as fast as we'd like. And coming into the quarter, we estimated X for impact of pricing, came in a little bit less. We lowered our number for the fourth quarter. But the most important aspect is on a price cost basis, we are neutral. And that's what we aspire to be. We'd rather just grow.
Mm.
And Dan, to your point, Fastenal, even with the pullback today, returning 22% year to date, so outperforming the S&P 500 and comparable stocks in the industrial space. But just one more question on pricing in terms of expectations. Would you want to raise pricing? Like, do you get the sense that consumers and customers would push back, just given how you've been shifting into bigger customers spending much more money?
Yeah, customers always push back on pricing. Doesn't matter the size customer. We are having conversations with our customer. We will be doing some price increases in Q4. I suspect we'll be doing some price increases as we move into 2026. But again, our first discussion with the customer, they understand it. They're willing to move on price. Our first discussion is always, what are alternatives to this product that maybe doesn't mean we have to raise your prices 5%. Maybe it means it only has to be 2%, and we'd rather go to 2% because that's what a supply chain partner does.
Well, Dan, how do tariffs fit into this? Just given that, according to analysts across the street, when we look at certain industries, now is when we're going to see tariffs showing up in the third quarter in guidance as it relates to 2026. What are you seeing, and how are you kind of attacking or addressing any pressures from tariffs?
Yeah, so for us, tariffs have been in the equation since the early part of the second quarter, a little bit of the first quarter. I think in the individual that handles pricing, historically he'll provide us an update once a month. He'd gotten to the point where he was not only providing us updates, he was up to video number 14 as of July that he was serving out to the field, giving them guidance into what we were seeing in our supply chain. And so we've been adding price as we've gone through the year, and these have been discussions with customers. And I hope that answers your question.
No, I think it does. But I think the big thing is, are you mitigating the impact of tariffs? Are you shifting your supply chain? Is the expectation that you can have some kind of knock-on effect as it relates to pricing if we do continue to see threats from the president going after countries like China or others? We are going to talk to one of the members of Levi's management team, and they called out that they had to dial up their expectations for the impact of tariffs from other countries. So how is that impacting when you look at your supply chain and when you look at the potential for pricing impacts in 2026?
We've been moving supply chain around the planet in earnest since 2017, 2018 timeframe. As our name would imply, we sell a lot of fasteners. And most of the fasteners in North America come from either mainland China or Taiwan. And the automotive industry took the production there back in the 50s and 60s, actually took it to Japan and South Korea, and it migrated from there. If I look at our resources, we now have a sourcing team in Shanghai, but we have a sourcing team in Bangkok. We have a sourcing team in Northern India, and we have worked to diversify our supplier base around the planet and a little bit more in North America, but really around the planet. So to have diversity in supply, so you're not caught off guard by some price change or a tariff change. In addition to that, we've taken supply chains coming in North America, which traditionally came in through the West Coast of the United States, and then we would redistribute from there. We have moved supply chains so they're bringing product directly into the West Coast of Canada or the West Coast of Mexico, because those two countries represent about 14% of our revenue. Now, you bypass the tariff, However, it's more expensive to break shipments down over in Asia and bring them in, but it's a lot less than a tariff.
One of the things I want to ask you, you talk about supply chains. Is the end game, Dan, we're talking with Dan Florness, he's Chief Executive Officer of Fastenal. Is it about, though, largely reducing your exposure to China, which has been a pretty big one?
It's reducing our customers' exposure to any market, in this case, China and or Taiwan, but to any market that are on the receiving end of some of the political winds and create an unstable supply base for our customer. Here it happens to be China. Another month, it might be a different country. Another year, it might be a different country. It's diversifying your supply chain so your eggs are not all in one basket.
Got to be ready. So
that's for our customer.
Yeah, whichever way the winds blow. Hey, one of the things I want to ask you just big broadly, the earnings update today, you talked about the industrial environment still sluggish. We've heard similar commentary on this persistent sluggishness elsewhere from manufacturers, as well as caution around project delays. At what point does this become something more worrying than just sluggishness?
For us, it's been sluggish since November of 2022.
Okay.
When so we really key on what the Industrial Institute for Supply Management puts out, the PMI index. And that's been sub 50, which really plays into our customer base. Other than January and February of this year, that's been sub 50 since November of 2022. So we've been in a sluggish economy for a long time from our perspective. And other than living through the first part of it, where you had customers that were downshifting, reason our growth is shining through in a different way, A, I think we're executing at a higher level, but B, once you get through that downshifting, now you're just, even if your customers are at a subdued level, you can grow in that kind of environment. And that's what's shining through in our numbers right now.
All right, one thing I want to ask you, because as you would imagine, I don't know how much of this is pervasive in your world, but AI is like the nonstop conversation that we are having, certainly when it comes to activity and market impact. To what extent is AI maybe sucking up the oxygen in the economy? Are you seeing any signs of that? Or your world, they're going to still need what you guys supply no matter what's going on with the AI spend and enthusiasm?
Well, first off, we have we have a meaningful improvement in our revenue as it relates to things like data centers, because we sell into a wide range of customer needs and end market needs, whether that is the actual construction. I visited many data centers being built where we have people on site there. After it's built, we're supplying into that facility with things like air handling and maintenance equipment. In the case of customers that sell into that sector, that's actually a strong business for us right now. And then as an organization, we're increasingly making use of AI in our own business and how we go to market and how we help our employees be more efficient in what they do.
And Dan, about 45 seconds here. With keeping in mind data center construction, where are those products sourced from? Are those also heavily sourced from China and exposed to tariffs, or are they a different supply chain altogether?
They're mostly a different supply source, but it depends on the component. If it's facility maintenance type products, they're coming from anywhere on the globe, and so they're subject to the same type of issues any product would have. But a lot of the components, I know a lot of the manufacturers that we sell into. I visited one about a year ago in Michigan, where they were purposely avoiding China, and they're selling directly into the data centers.
You've been at Fastenal for a long time. You've seen different cycles. How do you describe this one? And again, just got about 20 seconds, if you could be very quick.
Odd in the fact that, similar to what we saw in 18, but odd with the fact of it's just so damn fluid. And there's so many things that occur from week to week, month to month that are outside the norm, but the fundamentals still work.
All right.
Serve your customer at a high level, you grow your business.
Love talking with you, Dan Florness. He's CEO of Fastenal.
Stay with us. More from Bloomberg Businessweek Daily coming up after this. You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
All right, folks, Levi Strauss shares, they are trading slightly lower today after dropping as much as 14% on Friday. This is after the company's upgraded earnings guidance still fell short of higher investor expectations, following the stock's more than 40% rally heading into that earnings print. Now, one key disappointment, at least according to analysts out on the street, is earnings growth failing to match the pace of sales expansion due to tariff and distribution costs. Meantime, got to say, Bailey, you did have TD Cowen raising its price target on the stock to 26 from 22 a share, and they've got their buy rating.
Yeah, staying bullish. And you look at the street, 13 analysts, 10 of them buys. So is it a sell the news event, price to perfection? Mm-hmm. We see.
It's a really good point. So let's see what one of the company's members of the C-suite have to say. Harmeet Singh is with us, Chief Financial and Growth Officer at Levi Strauss. He joins us from our San Francisco bureau. Harmeet, it's so good to have you here with us. How are you, and how is the consumer doing?
Well, thanks for having me, Carol and Bailey. It's great to be here again. We had a real strong quarter, 4 consecutive quarters of high single-digit growth and record gross margins, as well as the fact that we were able to raise our full-year guidance, as well as gross margin and EPS expectations. Overall, as a company, we're a stronger and a higher performing company defined by accelerated growth, expanding margins, and higher return on invested capital. To your question about the consumer is largely being resilient. Our products are really well segmented. We have Blue Tab, which is our premium high pinnacle product, and that's doing well. We've introduced that in the US. So far, so good. We have a Red Tab product that is basically marketed to consumers who earn between $100,000 and over. And that's, based on our results, really done well. And then we have, our signature product sold through Walmart that, again, had a banner quarter, and that's for, lower income consumers. So consumer strength really strong. That's why we were able to raise the full year guidance, and our product pipeline hasn't been stronger. Now, if you go outside the U.S., our international business was up in the high single digit, and so Asia had a strong quarter, consumer strong. Europe had a decent quarter, consumer in a better place, and so is Latin America.
Well, I'm just going to lay it out for you. I think I bought my first pair of Levi's in a long time, just a couple of months ago. And my daughter, who's 22, so much younger than me, has been buying Levi's for a while. So, Bailey, I mean, they're back. I go into the store in downtown in the Village, and yeah, it's packed.
Well, you get a partnership with Beyonce, all the marketing you guys are spending in terms of targeting both young and older generations. But Harmeet, I want to ask about tariffs. So Levi expects tariffs from China about 30%, but increased expectations to 20% from the rest of the world. Where are you sourcing your jeans materials? Are you more exposed to that doubling in terms of, are you getting materials from Vietnam in place of China?
Yeah, so overall, we're taking a holistic approach as we are able to offset the tariff impact. As you think about this year, we raised guidance in the top line and the bottom line and gross margin. So, we've been able to withstand that. To your specific question, Bailey, we source about 1% we import into the U.S. from China, a little over 1% from India. And Vietnam is in the mid to high single digits. So most of our imports are from the Southeast Asian countries. Think Bangladesh, think Pakistan, and the rest of Asia. The way we think about our supply chain, it's fairly well diversified. We import from about 20 countries into the U.S. 60% of our business is outside the U.S. And so we're well positioned to mitigate and offset tariffs. And the way we're thinking about the holistic approach, given that volume is driving a big piece of our revenue momentum, and we have tenured vendor relationships. We're working with our vendors. We're looking at different cost efficiencies across our organization, as well as being very thoughtful about pricing.
So let me just ask you, though, you guys did, you mentioned you raised your full year outlook. You did warn that tariffs are starting to bite. Profitability to measure by gross margins improve. So these are like good stuff. But again, that tariffs are starting to bite. Harmeet, can you tell us what that means? What the bite of tariffs? When, how much? Any color around that?
Sure. So, overall, we were able to raise top line and bottom line guidance despite absorbing tariffs. And so we are able to mitigate it. To the question about tariffs, tariffs were introduced on Liberation Day. We normally buy our products, 6 months in advance. And so, we are working through, our efforts, and we've got different levers to kind of position it. So you take quarter three, the quarter we just reported, gross margins are record. So we're able to offset tariffs because we got other things working for us. As we grow our women's business, our direct-to-consumer business, and international, all of which are accretive to gross margins and allow us to mitigate and offset some of the tariff exposure. Quarter four, we did guide gross margins to be slightly down versus a year ago. And had it not been for tariffs, we'd have grown gross margins. But overall, as we think about the year, we'll report again another year of record gross margins. So we're working on levers for 2026. The good news is we'll end the year stronger, and we believe we're well positioned to have another strong year in 2026.
And Carol, we've talked with a good friend, Peter Atwater, for quite some time about that K-shaped recovery, where people who are well off are doing much better than those really in the bottom quintile. Harmeet, when you look at your goods, when you look at the ability to raise prices from the impact of tariffs, which products are you able to more easily raise prices where you aren't going to see consumers push away? And how are you thinking about that strategy as it relates to, say, the jeans that you do sell through a Walmart where you don't have that gross margin going direct to consumer, and you do have likely, at least when we look at the data, a consumer who's feeling the pinch of inflation, broadly speaking?
Yeah, and so the first thing, Bailey, to your question, is our products are well segmented depending on the income profile of different consumers. I talk blue tab, red tab, and signature. Signature is what's sold into the lower income consumer. We've been very thoughtful about pricing. We're leading with product innovation rather than price. And so we're doing what we can to maintain a price point. It was evident in quarter three. Signature, for example, I think is up in the low double digits for the year. As we think about our other products, the good news for us is our product pipeline has never been stronger. We're leading with loose and baggy while at the same time selling a lot of slim and skinny, both for him and her. We've got wonderful, waist up products to think trucker jackets, think linen shirts, et cetera, et cetera. And so as a company, we're making this pivot to be more of a denim lifestyle retailer going forward. Our past was all about denim. Our future is going to be about denim lifestyle.
I just want to know, do you really have a pair of baggy barrel jeans? I can't get my head around them. I'm trying. I haven't done it. Harmeet, what I do want to ask you too is you guys have had kind of a mission, a goal to get to 10 billion in sales by 2027. I think you may have adjusted a little bit. I think also a 15% EBIT margin. Could you reach 15% in the next few years, even if sales have not hit that 10 billion? Talk to us a little bit about that mission.
Yeah, no, we gave out the expectation of 10 billion and 15% on our investor day in the middle of June 2022. Since then, there's been a lot of change and a lot of uncertainty. As a company, we have kind of navigated our way through uncertainty. We haven't given a new date on the 10 billion and the 15%. Mm-hmm. Our thinking is we'll probably do that sometime next year. But to your question, the company that we are building and the company that is got the foundation given where we're ending this year. So you take 2025, we'll end at about 6% organic growth. Last year it was 3%. The year before that it was flat. If you think in EBIT margins, this year we'll end about mid-11s. Mm-hmm. Last year it was in the mid-10s. The previous year it was about 9. So we've seen a steady progress. And our view is we probably get to the 15% faster than we get to the 10 billion. Uh-huh. But really a company that is steadily delivering mid-single-digit growth in a category that probably grows a little, south of that. So our view is that we are market leaders now in the U.S., number one in men's, number one in women's, and really resonating with the youth. And so the question is, if you're able to stay at, and implement our strategies, our view is we can continue to be market leader and probably pick up a little bit of share, especially because the denim category is accelerating. We've seen the acceleration in the US, we've seen the acceleration outside, and that's largely driven by the world becoming more casual.
Yeah, I have more jeans in my wardrobe than I've ever had since high school. It's really kind of wild. Anyway, Bailey, I know you've got another question.
Well, I was just going to ask, in terms of geographic expansion, when you think about China, what's going on with China, and also what products do the Chinese consumers want? Is it that high-end good, or is it more of a bargain purchase?
Yeah, so China for us is still underpenetrated. China represents about 2 or 3% of our business. Our business in China has been slow and soft. The Chinese consumer right now is going through a bit of a macro uncertain climate. But the good news for us is they love the brand. Our brand equity scores are really solid. We think China can be, a business that grows double-digit over the long term. But to your specific question, the Chinese consumer is fairly discerning on the brands he or she gravitate to. There is a high-end consumer as well as a consumer the mid-market consumer, what we call the core products. So if you think about our Asia strategy, we really, our products are relevant for the mid-market consumer, while we also offer products for the higher premium end consumer. 30% of the Asian denim category is premium. Premium, for example, our highest pinnacle product is largely Japanese, fabric, Japanese denim, and inspired by selvage. And so that's what we are selling. And I think over time, we'll be able to start growing our China business back in the low double-digit range.
Yeah, interesting stuff. I will say, Carol, I know you mentioned you have more jeans than ever. I have been buying the Sherpa jackets, the denim jackets, like crazy. I don't know why. I have 3 of them in different colors.
I bought a bunch of denim jackets
that's
too.
What I'm in. I don't wear jeans. I wear chinos, but I wear the denim jackets like crazy.
I know. I don't know. I love it. I ask everybody I work. I walk in with jeans every morning.
Yeah, and Bailey and Carol, now we've got the blue tab. It's a fuller jacket. You can definitely wear it to office depending on the dress environment at Bloomberg. I walked in here fairly casual, so it's something that we are not beginning to offer, which should make your wardrobe at some stage.
Hey, one last question. Does it feel like, God, Harmeet, it's been a crazy year? And a lot of stuff coming at everybody, investors, the world at large. Does it feel like things are starting to calm down on a day when we've talked about what seems like progress in a ceasefire between Israel and Hamas?
Yeah, as I mentioned earlier, we have lived through uncertainty. The good news for us is the category is strong. We have real business momentum. The brand's never been stronger, and we have a product pipeline that is never been fuller, especially as we head towards holiday. Our focus right now is making sure our product is on the floor. Because what we have seen, Carol, is consumers gravitate to newness and gravitate to what's relevant. And our view is if we can offer the right product and build a brand experience. And that's where we've got real focus on our direct-to-consumer business while complementing growth with our wholesale business. So this quarter, both DTC and wholesale was up. We had, in the U.S., 5 consecutive quarters of high growth, and it's fueled by both the channels.
All right, well, Harmeet, when you talk with your design team, I like high waist, buttons, kind of slim through the legs, and then a little flare. I'm just going to put it out there. A little stretch in there, too. It's kind of my favorite. And you are a gem. Thank you.
Yeah, and I'll take that feedback, Karen. I sincerely believe feedback is a gift. And getting feedback from consumers like yourself is something that I'll take upon myself to feed back to our designers.
All right, I'm going to hold you to it. All right, good stuff. Harmeet, thank you so much. Harmeet Singh, Chief Financial and Growth Officer over at Levi Strauss, joining us from our bureau in San Francisco.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.